Okay. It takes such a long time to start re-recording again. Okay. We're going to look now at our periodic inventory system. Quietly, please. And please remind me to call the roll before you all go, because I've forgotten to do it today. You must remind me to call the roll. Okay. We've looked at the perpetual inventory system and all of those transactions that were on the card, plus a few extra things like the settlement discounts and the freight charge journal entries. Now we're looking at exactly the same card, if you like, or the same transactions, looked at from this thing called the periodic inventory system instead. Now, periodic means repeating in a certain period of time. That's what periodic means, okay? So something's happening again in a certain period of time, and the periodic inventory system works on the same time frame as your accounts, okay? So if your accounts are over a 12-month period, then you would actually only review your inventory balance at the end of the period, okay? So periodic means within a certain period, okay? And generally we're looking at our 12-month period. Sometimes in an exercise that I might give you, it'll be a 1-month period, okay? So that'll be the period of your periodic system will be 1 month, okay? So the beginning balance of inventory is not changed until the end of the period. That's really important that you understand. So your beginning inventory balance would stay on the accounts exactly the same regardless of how much you've bought and sold during the period. You don't alter your inventory. You don't directly alter your inventory balance in your ledgers, okay, with these transactions. Purchases aren't recorded into inventory. They're recorded into a purchaser's account. So you have a separate account called purchases. And you don't record cost of sales every time you make a sale. Okay, so the journal entries are slightly simpler for the periodic system. The ending balance of your inventory is determined by a stock count. Now, it's not to say that with the perpetual system you don't do a stock count, because you do a stock count with either system, but the stock count with this particular system determines your ending balance, okay? So you don't really know with this system how many things you might have broken or lost or had stolen from your inventory during the year, because you've been recording your sales, but you don't know what's happened to those other types of things that might have happened. Whereas in the perpetual system, you're updating your inventory all of the time. So if you dropped 3 boxes of glasses, you could take them out of your inventory. You'd have to expense them at the time you drop them with the perpetual system. With this one, you don't know about that until the end, and then when you do your stock count, you think, oh, that's right, I dropped those glasses. Okay, I better take them out of stock, out of my inventory balance. So it is, it's a much less scientific system. It's a much less used system than it used to be. Most businesses now have computers. They use scanners, things that make using a perpetual system possible and easy. Whereas in the old days, they had to, when it was everything was much more manually done. Many more businesses would have used this type of arrangement because it was a lot easier for them to do. It didn't involve so much counting and recounting and re-recording and all that sort of thing along the process. They simply knew their stock balance at the beginning, or their inventory balance at the beginning, because they had done a stock take on the last day of the previous period. That was their beginning balance. On the last day of the current period, they did a stock take again, and that was their inventory balance at the end of the period. Okay, so they had a beginning balance and an ending balance because they counted what they had. Okay. The transactions are a bit simpler. So if this is going back to that stock card that we had in the perpetual system. We're going to do all of those same journal entries again from the periodic system's point of view. So some of the transactions will use slightly different account names. Some of them will miss out the bit about cost of sales because you don't record cost of sales with this method. You work out cost of sales at the end from your beginning and ending inventory balances and the amount you purchased in between. Okay, so I'll show you that how we do that probably on Thursday. Okay, so with this one, you don't record into an inventory account, you record into a purchases account. So you're debiting purchases, the same amount as before. You're debiting GST outlays. Outlays always go along with anything you purchase. And it's a purchase on credit, so you're crediting accounts payable $7,150. Exactly the same numbers as before, using purchases account this time. That's the difference. Okay, the freight cost is done exactly the same. If you're the person who's paying for the freight costs of those things to be delivered to you, it's a freight inwards. It's part of your cost of sales in the end, which is why I've done it in red, okay, on that slide. It will become part of your cost of sales, a freight inward amount, because it's a cost to get the inventory to you, ready for you to sell to somebody else. So it is actually a cost of sales in the end. Okay, so otherwise the same journal entry as we saw previously. Recording sales on credit is exactly the same as we've done in the perpetual system, but you don't need to record cost of sales. Okay, you've got a sale and that's all you record with the periodic system. Numbers exactly the same, accounts exactly the same as the previous system, no cost of sales to be recorded. Recording purchase returns is exactly the same as previously. You're using that separate account purchase returns and allowances, just exactly, different. With the other system, you changed your value of inventory, didn't you? So sorry about that. You would have actually reduced your inventory for a purchase return. This one, you keep your purchase returns separately in a separate account because you're not updating inventory all of the time with this system. Okay. Recording payment of creditors within the discount period is exactly the same as the other system. So we don't need, I won't explain that one again. It's exactly the same as the perpetual system. Recording sales returns and allowances is actually exactly the same as the other system. Remembering sales returns are important information for both the business and for an external person looking at that business. They want to know how much is coming back, so keep it in a separate account. Okay, so those transactions are quite a lot simpler than the perpetual system. Now we're going to look at the two income statements that would be produced depending on which system you've used. Okay, this is from the perpetual inventory point of view here. It's those same transactions, so you would expect to end up with the same profit figure, but you get the information from different places here. Okay, so with your perpetual inventory system, you've got your sales revenue, less sales returns and allowances to give you a net sales revenue. Less cost of sales. So remember, the perpetual system keeps an account called cost of sales, so you know exactly what your cost of sales are. You can just put it into the accounts to give you a gross profit. Okay, then you would put in any other costs. That cost of sales includes, let's just see here, the original sale, less a sales return, plus some freight inwards, less a discount that you received because you paid your supplier more quickly than the 10-day period he gave you. Okay, so that's where that $1,603 came from. Okay, with the other statement, it looks a lot more complex, but you end up with exactly the same profit figure. So this is your periodic system, and this is if you were do an example with the periodic system, you would set out this central bit to record your cost of sales. Where does it go to? Right down here. All of that is your calculation of cost of sales. Okay. So if you write down on the side, cost of sales equals beginning inventory plus net purchases, which is this calculation here. Beginning inventory plus net purchases less ending inventory equals cost of sales. Okay? So there's a lot more calculation to be done, and you do see the manual calculation in your statement for the periodic system. Cost of sales equals beginning inventory plus net purchases less ending inventory. There's your cost of sales. Okay, so that's the calculation for cost of sales. You expect to get the same gross profit no matter which method you use, and that is the case. You do get the same gross profit figure. This one is a bit more complex to work out though. Okay? of period processes is your closing entries. Closing when you use the periodic system. At the end of period, you close off your beginning inventory in one of your closing entries. So this is what you're doing here. Your beginning inventory of 58,400, you're reducing to zero here with this transaction through utilising the profit and loss summary account. And then you put in your new inventory balance here. So now your inventory from your stock take is valued at 53,260, and that closing entry, closing it here and opening it here, really, is how you achieve that. So when you're doing closing all your expense accounts at the same time, you would close your beginning inventory balance here. And then when you're closing all your revenue accounts at the same time, you would actually open your closing inventory balance, your ending inventory balance. Sounds very confusing. In the textbook, if I just have a quick look, I should have written the page numbers down, but I didn't. But I'll just find there's a very important page with the closing entries for different systems. And I'll just give you the page somewhere. I know why I can't find it. I'm looking in chapter 7. It's in chapter 6. Okay, if you look on page 249, it gives you the two income statements, one after the other. And then if you look on page 253, it gives you the two closing entries for that particular example next to each other for the perpetual and the periodic systems. Okay, so write those two pages down. Page 249 to give those two statements that were on consecutive slides gives it on the one page. And page 253 gives you your closing entries for both systems. Okay? So if you're using the perpetual system, you don't need to do anything with your inventory balance in your perpetual system because it's a permanent account. Inventory is a permanent account normally. It's only for the periodic system that you're doing this strange thing here where you're, taking out the old inventory balance and putting in the new inventory balance through the use of your profit and loss summary account. Okay. This just shows you what you've actually done with those two journal entries on the previous page. Okay, we've got our inventory at the beginning of the period, 58,400. When you do the closing account, the first closing entry, you would credit your profit and loss. Credit your inventory account here. That's the other side of the journal entry. And then you're putting in your new balance, so you're ending up with 53,260 as your ending inventory balance. Okay, from that, two journal entries in the closing process for the periodic system. Okay, a detailed income statement for a retailer. Now we're talking about those other expenses that we have at the end, the selling, administrative and finance expenses, and how we separate those expenses to get them into the income statement. And we'll just see it with an example. The reason that we put them in after we've got our gross profit is to highlight the fact that we have how our gross profit differs from our actual profit by all of these other expenses and where most of the costs are actually going to, where most of the expenses are being used up, or most of our profits being used up. Okay, so if we looked at, this is from the textbook, this slide. So we've got the first part of it here where we've got our revenue, sales revenue, our to get to our net revenue here. We've got our inventory and our purchases, net purchases, our closing inventory. So what system is this using? Periodic, it's correct. You can tell from the statement that this is a periodic system because it doesn't have an account called cost of sales. It has an account called purchases. There's two things you'd look for. Okay, Okay, so you have to work out your cost of sales from information to do with your purchases and your beginning and ending inventory. Okay, we've got down to gross profit here. Then we go on to the next slide, which will give us the rest of the information for this particular business. They had some other income from something or other. Oh, here we go, rent income, rent revenue. So we've got our total gross profit there. Then we're going to separate our expenses into either selling and distribution expenses, administrative expenses, or finance expenses on the next slide. So things that are selling and distribution expenses would be salaries to our salespeople, or any commissions that we pay to our salespeople. That's the two ways that salespeople are actually paid, either in wages here or in commissions. Freight outwards is a selling cost. That's when we're paying for our goods to be delivered to our customer. That's a freight outwards cost. That's a cost of selling. You're not going to sell those goods unless you pay for them to be delivered to your customer, okay? Advertising expenses you would have as a selling expense because it causes you to hopefully sell more things, so it's a selling expense. The rent expense on the store space would be a selling expense, and any depreciation related to that store space depreciation expenses would be included in your selling and distribution expenses. Okay, things that would be an administrative expense are any salaries of your office people, so not your selling staff, but your office or administrative staff. That would become an administrative expense, and that's pretty understandable. Any rent expense that relates to the office space would be an administrative expense. Any depreciation on things in your office space would be an administrative expense. Insurance expense, that could be also, you could be insuring your inventory, so it could be a selling expense here. It depends what you're insuring, where that expense would go. If it's a general insurance, you'd normally put it into administrative expenses. Okay, and the last one, finance expenses are normally just things like interest. That's a finance cost of finance, so it's a finance expense here. You've got your profit before income tax, $44,280, less income tax expense of $10,470, to give you a final profit figure of $33,810. So if we go back to the slide, we started with our net revenue. No, one more slide back, sorry. We started with our net sales revenue of $689,630, and we've ended up with a final profit figure of only $33,810. Okay, and that's pretty normal for a retailer. They have to work very hard to make a profit. They've got to make a lot of sales. Okay. I think we'll put a cross through that slide. We're not going to worry about that little part of the course, so don't worry about this, the net price method. We're not going to worry about that with this course. And we're also not going to worry about this slide because we do slide right at the end of, or we do a whole week on financial ratios in week 12. So again, don't worry about that slide at this point. I won't ask you to do those at the moment. Okay? And that's it for today. Thank you very much. Yes? Yes? This one? So weren't they on your slide? They didn't come out?